Welcome back, everybody. My name is Darson Grantham. On this video podcast, we kind of just talk about all things real estate in Des Moines, local economic business. Co-host Jared Huseman, he'll introduce himself and kind of tell you all about him. But just stick along and we'll talk about, today we're going to talk about all of the different types of return that a real estate property can be evaluated on and why they're all bullshit and they're all important at the same time.
It's funny you said it, Darson, because I think every metric that you have out there is all bullshit, yet it's all relevant, and we'll go into why. Jared Huseman here, president of the Catalyst team, part of KB Commercial Realty, multifamily investor specialist here out of Des Moines, but we work across the state. Again, with focus on apartments. And getting right into it.
No, hold on. Let's go. What's happening in the economy? What's happening local, national? Let's kind of touch on that stuff. Nationally, today is Wednesday, the 10th, and the CPI just came out below expectations. So the stock markets all went up considerably. For whatever that means, it's a part of something that most business folks, most business owners, anyone that's paying attention to the markets pay attention to. I do not recommend making decisions based off it. Just like when it goes down, I don't recommend making decisions off that, but just a perspective of what's going on in the world today.
Well, the CPI, if you don't know, anybody following, is Consumer Price Index, which basically just tracks consumer goods, whether they're going up or down. So if it came in below expectations, it means inflation's cooling, which means, of course, the market can take that in a positive light because it means consumer things are starting to slow down. So obviously the market's reacting that these high interest rates are working to slow down the inflation or at least putting a damper on the market. We are still seeing a lot of wage growth, though, and strong wages and strong employment across the country. So with CPI coming down but employment staying high, people are taking that as a positive sign.
Did you see, so I looked at one report, my gold guy, what's the gold guy's name? Anyway, he
the gold guy?
Yeah, he's hates Bitcoin, loves gold. Anyway, he broke down the jobs report that was last week, right? And it was majority of service industry job increases. And so does that really help an economy? Is that really something that is a positive for an economy? And I don't know the answer to that. That's one of the questions that he brought up, and it raised it's not manufacturing, it's not housing, it's truly it's extra spend, right? So it's an indicator, yes, but does it help the economy?
It's funny because people would say that manufacturing is always what drives everything, and you have to create some kind of goods. However, I can also make the case that manufacturing output hasn't been a thing since the Industrial Revolution, and that we are a consumer-based economy, service-based economy anyway. Yeah. So, especially in the information age, how many people out in the world, anybody out here watching, we all know on YouTube or any of their channels, makes money by providing information, and not necessarily a good. So, if services are up, that could be a good thing, People don't only pay for services. So maybe that's
service, hospitality and service industry, not services.
Right, so hospitality and service.
Hospitality and service.
Okay, so not the services industry.
Not hospitality. Not lawn care, lawn maintenance.
So that's very, very specific. Yes. Although I would argue that all services jobs are up right now in labor. I would say that.
Yeah. So anyway, kind of it's funny how you can hear one thing, think that's a really good thing, and what does it mean, right? Because a high or a low CPI, right? What are we going to do with the rates now?
Right.
What is the Fed going to do? They're still, they don't meet again for a month and a half or two or whatever.
Well, it's funny because this actually ties really well into what we were talking about today's metrics about in real estate and investments. But this all ties back around to what we're going to say here is that at the end of the day, it's all bullshit. Because at the end of the day, CPI, it's lower today than what it was expected. What does that mean? No one really knows. We just do our best to understand what that is. But it's like saying that outside is 32 degrees, and you're saying, well, it's snowing then, right? Well, it could. I don't know. Maybe it doesn't. Maybe it does. It doesn't. These are just metrics at the end of the day. They don't show anything, and that ties back to what we're going to talk about today. Is they
don't show the end all be all.
Well, they
paint. They're like a brushstroke in a painting.
Well, at the end of the day, any metric you have is going to it's a metric that is showing the past. No metric can show the future. Yeah. At the end of the day, that's the easiest way to put it, is that every metric you're looking at, I don't care whether it's cap rate, cash on cash, CPI, even the stock market today is showing the price.
Perfect. Good segue. Let's break this down into the matrix of real estate, or metrics of real estate. Not matrix, that's way different.
Metrics.
Metrics of real estate, but just the general ones. Obviously there's, you can get really in depth on this, but you have cash flow, you have internal rate of return, you have cap rate, you have
cash on cash.
Cash flow is different than cash on cash.
Can be different.
But can be different, can be the same.
And then return on investment, ROI.
Okay.
Those are probably the most common ones that investors use when they're measuring different levels of return. And as you kind of alluded to earlier, we won't go into all the details here. That's for other Investopedia.
We're not going to get into how to calculate all of this.
Right.
Just because that's more education. You can go YouTube it, figure it out.
YouTube or Investopedia, by the way. Investopedia is a great one. But at the end of the day, these are all metrics. And sometimes they can be the exact same, sometimes they can be the exact opposite. It just depends.
Word association. When someone says cap rate, what do you think?
A cap rate, I think of the value of a property, and then the property that it will return as a yield or return on investment. So 10 cap means 10% return, 10% yield.
Yep.
10% cash on cash.
Not that I'm quizzing you, but it's fun. Like, first thing you think about, like when I hear cap rate, I think, oh shit. Like, it's a fake number. Because you can manipulate it so many ways, right? And I say fake, unless you do it yourself, it's a fake number.
So here's the thing about cap rate is that unless you start getting to the institutional level, the capital markets, which is the 10 million plus range, usually $20 million plus range, anything less than 10, 20 million, every cap rate you're going to see is probably bullshit because every owner, mom and pop ownership individual is going to calculate it differently. And no one will use the exact same set of methodologies of accounting and GAAP principles and the accounting world to calculate their cap rate. So any cap rate you're looking at on a property that's very, very, I would say, low value, I guess, less than 10 million, which again, 10 million is a big number, but less than that, it's probably a bullshit cap.
Yeah, it's just not, it's not what it shows.
Mm-hmm. Well, it goes back to why you hire specialists as well. I mean, I've had this conversation a lot, not with yourself, with other residential agents.
You probably had it with me too at some point.
Maybe at some point, but I've had arguments with a couple of residential agents over the years where they say they can do commercial real estate and ask why, and they say, well, they understand cap rates. And I say, well, do you understand what goes into the cap rate? Because I can give you any cap rate you want. Just tell me what I need to manipulate.
Yeah.
And again, that's why the question comes up a lot when people are looking at deals is, do you want pro forma cap or actual cap? But let's go back to this again too. Whether it's pro forma or actual cap is great, but if all of a sudden COVID happens next month, an actual cap on a retail building might be shit next month because something happened that was a black swan event and now your cap rate means nothing.
Yeah, but that's black swan. So, I mean, it's relevant, but it's not that relevant.
But that's the point I'm making is at the end of the day, cap rate still is predicting the past.
Yeah.
And if pro forma tries to predict the future, which again, I said earlier, no one can predict the future. So that's where
Which is why it's not a bond.
Right.
And even bonds,
even bonds are really questionable.
But you're investing in something, real estate, gold, crypto, stocks, whatever it is. You are putting a portion of risk out there in order to get a return.
Right.
Now I say risk. I hate the word risk because it's not risk. It's volatility. That's probably a better way to put it.
Yeah. I think about that one would be maybe a synonym for risk there on that.
Because it's not risk. It's a chance of volatility.
I would say more of a probability of anything as well. You're essentially playing a probability of something.
Yep.
I wouldn't call it risk. It's just a probability.
Okay.
So anyway, it doesn't matter.
Yeah. So next, when I say internal rate of return, what do you think?
Bullshit. That one I call bullshit on. So, which we talked about a little bit maybe earlier. But for anybody who doesn't know, internal rate of return is an IRR. It's used a lot by the big groups, actually, organizations. And essentially what IRR does, I'm going to explain this one for a second for everybody not watching. IRR tries to take into account all your cash flow that you would obtain from a property. They try to anticipate what you're going to sell this property for in however many years. You can choose 1 year, 3 years, 10 years, 7 years, 20 years for all that matter. But you try to anticipate the sale of property, take the sale of that property, minus what you bought it for, take your profit, and then you roll that number into your cash flow as a profit to create your internal return. So for example, I'll use really easy numbers. You buy property for $5 million, you buy it for a 10 cap, create $500,000 a year of revenue. You sell it in 5 years for $10 million. You're gonna take that $5 million profit plus your $500,000 of cash flow every year, add that together, divided by your $5 million, and that's gonna create your IRR, your internal rate of return. The problem I have with internal rate of return is too often people use it as a predictor of the future, and they say, I'm gonna sell a property for X or Y or Z, and anybody tells you what they can sell a property for, and then so many years is fucking lying to you, or they're trying to sell you something or convince you to part with your money. Don't believe them. The only way you use IRR is if you are looking backwards and saying, I sold this property in 2021, in 2022, and here was my internal rate of return based on what I already did. But you can only use IRR, and again, looking backwards.
So your big issue with IRR is the fact that you can't estimate the value and what you're going to sell it for in the future.
Correct.
That's the big thing.
That's my big thing. Unless the only time I ever tend to follow IRR, and a lot of syndication groups and investment groups use IRR as a way to prove how much money they're going to make. They're going to show a 15 or 20% IRR to try to get you to invest in them with their fund, their money, whatever it may be, that institution or that person. The problem with that is that they can say a sale price of any number they want to create that IRR. They might have an IRR of 12%, but they know no investor is going to do that. They want 15%. So we're just going to bump the sale price. I think we're going to be a little more aggressive on sale price, and boom, we did it. We hit our numbers, and all of a sudden we're good. The only time I believe IRR ever is if someone says one of two things, which is weird. Either I'm going to sell this property for more than 5 years down the road for the same amount of money or less. That's the only time I believe IRR.
So if you don't believe what the property can sell for, why do you believe you know what rents will be in 5 years?
That's, again, a whole nother debate. All I would say is, again, too, the only time I would believe IRR, and again, this depends on what property asset type you're underwriting too. This is an industrial lease to Amazon. I can believe the rents are going to be the same for 5 years. If it's apartments, I believe they're going to be stable for 5 years. So I only use IRR based on what we're underwriting the asset. And again, I'm going to always only believe IRR if you're future pacing this.
Gotcha.
If the property is in the IRR and the numbers is set to sell for the same amount or less. Because if you tell me right now that a retail, industrial, office, or multifamily deal is going to sell for the same amount or less in 5 years or 7 years, then I will say, okay, I believe that, because the odds are you're probably going to have some appreciation in there.
Yeah.
But I'd rather play the negative, worst case scenario than say that a property is going to be selling that you buy today at $5 million is going to sell for 10. If you tell me it's going to sell for $5 million or $4 million in 5 years, because at that point it's aged.
Yeah.
Property ages, or it needs CapEx, whatever happens.
Right.
Then I will believe you. So if you say it'll sell for the same or less, I will believe in IRR. If you just say it's arbitrarily going to sell for any number, it totally is bullshit.
Yeah.
So I don't like IRR for that reason. I don't even use it. I'm going to forward ahead here. This is why I like the cash on cash number. For cash on cash, pretty simple. You put cash in. How much cash do you get back out your first year? That's it.
Cash on cash. Do you use it as a percentage or a dollar amount?
Percentage. Usually.
Percentage.
Yep.
And then cash flow is a dollar amount.
Cash flow is a dollar amount. Yeah,
okay. That's the only difference, right?
Yeah, that's good way to put it. No, it's a good way to put it. I agree, 100%. Yeah, cash on cash is percentage, and cash flow is your number.
Yeah, cash flow, and we can get cash on cash too. Mm-hmm. It is why we're doing this video, is because I ranted this morning on my TikTok and all my channels or whatever of just like the mind-blowing number of investors that come to me and say, I want cash flow. Can you find me a cash flowing property? And I always tell them yes. Yes, I can. If you put 100% down, I will find you a cash flowing property.
Yep.
Easy.
Yep. Because all you do is
easy.
you can buy a one cap deal. You could go buy a house for $100,000 that rents out for $100 a month, and you've created cash flow.
Correct.
So
that's my obnoxious answer to they're trying to ask the right questions. They're using the lingo, but they haven't really thought about what goes into that calculation or how to articulate what exactly the property they're looking for.
Right.
And so if you are an investor that you're trying to tell someone the type of deal that you're going after, and you say cash flow, don't. Mm-hmm. Just don't use cash flow. Unless you're going to tell them, I need cash flow, and these are the metrics that go into the cash flow.
And how you calculate it. Well, I think on your video as well, we talked a little bit about this too, but cash flow is so arbitrary because, I think you mentioned as well, let's say you do what's common in your industry, the BRRRR, the buy, rehab, rent, refinance. You buy a house for $100,000, you rehab it for $50,000, and then all of a sudden you rent it out for $1,500 a month, to just say easy numbers. Yep. Now all of a sudden it appraises for $225,000, $250,000. You refinance, you pull your money out. You might only have $10 cash flow.
You'll always be negative.
Yeah.
Almost always be negative when you do BRRRR. I mean,
right. Close. But either way, let's say you created a very little cash flow or no cash flow, but you have no money into the deal. You've pulled all your money back out of it.
And you pulled out. You pulled out more money than you put in.
Right. So at the end of the day,
then it's infinite returns. How do you put that on your net worth?
Right. How do you calculate an infinite return like that? And that happens. I mean, I've done it myself.
I've done it. I currently have property that I put $0 into it, and I still own it. I have a first and a second mortgage on 2 properties.
Yep.
I mean, infinite return. Now, do I make a killing on it? No. Do you have $150,000 of equity in it? Yes. Should I refinance? Yes. Just haven't done it yet.
This totally ties back into something I saw a video, hate him or love him, but Grant Cardone mentioned this one time, and he always said the wealthy never sell for this reason. He goes, because if you own real estate and you never sell it, you can always refinance and your return is infinite. Because you buy it, and actually I saw, I'm going to pull out another number here, people get mad at me more, so why not keep going. Donald Trump bought Mar-a-Lago, which is in the news a lot in the last couple days.
Yeah, what happened? Never mind, we can get to that. Sorry.
He bought it for $10 million. It's now worth $350 million.
Terrible.
So, again, he put $10 million in. He could have refinanced that out, let's just say at $150 million right now, and pulled $150 million out on a $350 million investment. Very low loan to value. He paid $10 million for it back in the day. Your return isn't even like infinite. It's beyond. It's
well, there's nothing bigger than infinite.
Yeah, I mean, it's just so crazy. So again, that's the whole point, though, is that using these metrics don't really mean much based on what you're looking for. Because if you own forever and you pull your money out, your cash flow, your cash on cash, your ROI, your IRR, all that becomes eventually infinite.
Yep. And so, like, taking a step back of like how to think through, they matter, but they don't matter. Like,
Right.
How do you kind of think through them? In my analogy, you're the analogy pro, so let me know what you think. It's like a funnel, right? So your top level analogy, my go-to thumb when I just firsthand look at a property is the 1% rule. Where does it come on the 1% rule? Just easy rent versus what the price is. And that, now we haven't really talked about the 1% rule. It's you buy a $100,000 property, it rents for $1,000 a month.
Yep.
That's the 1%
Easy.
rule. So I'm not always looking for a 1% deal, but I always calculate it against in my head. That's the first top of
That's
the
your
funnel.
baseline. That's your
My top of
baseline.
funnel. And then you dig into like then my next is cap rate personally, because I want to know the actuals cap rate.
Yep.
And then I'll run the pro forma cap rate.
Yep.
Between those three calculations, if I get to that point and it still looks like somewhere between 6 and 10, like it's in the realm of me making a lot of sense.
Yeah, so ironically, I'll go through my exact formula for buying property. And it's funny, we're talking about this actually, but just wasn't planning on sharing this, but I will. Having now...
Don't give away your secrets.
No, it's not secret. And it's something me and a friend of mine were discussing even 2 weeks ago. And he owns even more than I do. And owns a huge brokerage company and real estate. But... And someone, if you
We're
don't want
small
to know,
potatoes.
yeah, I mean, somebody, if you want to know, I've done over, I gotta look at numbers, some like, I don't know, 70, 80 transactions personally over the years, over $15 million of personal assets, owned or bought, purchased, I don't know what, it's something like that, who cares, it doesn't really matter. But here's what I've learned.
You've done enough to make your word relevant.
Yeah, I've done enough where like, it doesn't really matter, numbers are there, it is what it is, you can read about it on Google. But here's what I will say, when I look at a deal, here's what I look at, first thing first is location. I've learned at the end of the day, none of these metrics mean jack if location is not what I want. So I don't look at
How do you
numbers.
define? Never mind. Okay.
Yeah, so I look at location, and then I look at basically how do I create value out of that location. Value in terms of management, rehab, whatever it is, and those are my two metrics. Location, is the location what I want? Is there value in what I can do? And all those metrics mean nothing. Those all come second after that. Then it starts coming into what's the cash on cash, what's the ROI, what's the internal rate of return, whatever it may be. But for me, I've learned, again, back to our point about all these metrics being crap, that I don't even look at them. The best deals I've ever done in my commercial, especially my commercial as well, have both been deals that when I bought into, there was in the first year a negative cash on cash. They were very low cap rates. In fact, they were actually inverted cap rates.
Inverted is a nice way of saying negative.
Yeah,
right?
as in I was buying a 2% cap and borrowing at 4% from the thing. So
Well, at least it wasn't a negative cap rate.
right, I mean, and had some of those sometimes too. Possible, yeah, you could actually have two because it loses money. But the best deals I've ever done were badly managed. They had some kind of value there, and again, none of these metrics meant anything because they had nothing to do with the property. Looking back on it, if you looked at my internal rate of return on some of these properties or my cash on cash, my ROI, actually I know at least two of them are infinite.
Yeah.
Even though I bought it, this is a sizable. These are sizable deals here too, and the return now, looking back in the last 3 to 5 years, has been infinite. But when I bought in, it was absolutely crap. So this is why I don't even follow the metrics until I look in the past, look back at what I'm doing. What I like to look for again is location and how can I add value. I've got another client, we were discussing this last week about he wants to buy more, and just going over his criteria, and he just basically said, deals that are weird was kind of how he put it. We started talking about it and joking because I've helped this client on a couple of transactions. And on a couple of transactions we've done together, they were the deals that were kind of weird. They were just kind of like, yeah, I think there's some value here, and here's why. And there was nothing on paper that made sense. And they've both been great deals for him. So I don't usually follow his metric, but if I did after that, then I do use the cap rate as a baseline. In commercial, that's our most common
So you do
one.
you funnel things.
Yeah, it is location, value, and then it would fall into cap rate and the rents. And then from there, I do look to a pro forma, what I could do. I like to use ROI as a return on investment because I like to calculate in, I think one of the most underappreciated forms of real estate is the fact that we can use debt on properties.
Yes.
And so many people will say, oh, well, I need cash flow. Okay, great. But if you're buying a $10 million commercial real estate, in my case, let's just say commercial, and you're literally paying down $30,000 off the principal, you're literally gaining $300,000 a year of net worth from somebody else paying it down for you, helping you. So
few people calculate that in.
And I calculate it all the time on my deals. I've learned you need to start looking at the phantom areas of real estate. And again, I noticed yesterday on my team, you start using things like the depreciation advantages and the cost segregation analysis, which I know one of our clients has done as well.
It's crazy.
And the tax advantages of these things. And also these numbers start changing drastically. So yes, we can do cash flow, cash on cash, but you start looking at all the other returns, you can start adding, start stacking, especially as you get more experience, cost segregation analysis, depreciation, the infinite return, all these things. It's amazing how fast.
It comes down a lot less to what's the cash flow, and then what's the net worth change in 2 years,
right,
or 1 year, or 5 years,
right. It's just, again, and this is just, and part of this just comes from experience from anybody that's watching.
Oh yeah. When I was first buying, it's all I bought was cash flow.
Yeah.
When I was like, I'm going to do the least amount of risk possible. I'm just going to buy cash flow, and it has to meet these metrics, so I'm not going to do it, and that's fine. But I didn't use a realtor,
right?
Because no realtor's bringing you those deals,
right? And at the end of the day, I'm going to relate this back. It's just the school, whether it's a school or School of Hard Knocks or the school in general. When you do school, you learn how to count. You learn 1, 2, 3, 4, 5. And then first grade, you learn actually how to add those together and subtract them together. And then you learn how to divide. And then you learn how to multiply. Then you learn how to do it even further. It's the same with investing, guys. You start off with learning what cash flow is. But what I'd say first is learn what great location is, or what a great location could mean to you and why. And
that's so hard.
But that's
hard to learn.
It's a personal thing.
Yeah,
it's a personal thing.
That's what I mean.
Again, I'll just share a personal experience here, guys. My family has made a lot of money investing in small towns because they live in that small town. And location for them was perfect because they could manage it. They knew everybody in town, and they made a lot of money doing that. So location for them was different than what it means to me.
Yep.
Location is your personal knowing yourself, which is the hardest part, ironically.
Yeah.
But figure out location and then figure out value, which again, those are the two hardest parts actually of all of it. Because once you figure out how to see value, it's your own personal story. But then again, then you go to cash flow and you start stacking these on top. It's called skill stacking. You stack from 1 plus 1, and then you learn 1 times 2, and then you learn how to do long division. And eventually you're going to get to the point where you can start doing these analysis of cost segregation, cap rates, performas, ROIs, IRRs, and you're looking back going, holy crap.
I hope that I can never do those.
Really?
I don't want to do those. I would rather pay someone to do those and do that for me.
So have you figured out then the top two, then location and
the cost seg part, the cost seg and the tags, like the tax stuff.
No, yeah.
I look at that as I'm like, that's just the cherry on top of buying real estate.
Yes,
I'm not going to try to figure out, should I buy this property because cost seg, because the tax benefits.
Yes.
I don't want to buy a deal because of the cost seg, because of the tax. I will buy because of that, but not the exact numbers. That's how I look at that.
Well, it's again back to even like I was saying earlier with I don't follow per se cap rates or cash flow or those things. Those are all extra things, and I'm betting on them eventually to help out and win. But then I'm going to buy first off is location and value.
Yeah.
Cool. And then at that point we start figuring out the rest. But I agree. I mean I'm never going to figure out a 1031. I'm never going to figure out that. That's why you have a team. That's why you have accountants. Why you have attorneys.
Yeah.
My job is to look at the big picture, and understand what that does, and go from there.
Yeah. I think to round this podcast video out would be. Know your strategy and talk to others about your strategy, because when you talk to other people about it, it'll help you narrow it down.
Well, I want to tie back to one second here as well, because here's the thing is that a couple of things I will say on this as well is that one, your strategy could be cash flow, or your strategy could be appreciation. Yes. And remember, those are two very different strategies. If you're literally saying I'm investing for net worth or appreciation, it's a very different strategy than investing for cash flow. Yep. So first of all, understand that. Second, what I would say is if you are new, and this is where I argue with all the gurus, but they're gonna, of course, that's how they sell their shit, is try a little bit of everything. I know that's maybe not fun, but I've learned from experience I hate flipping houses and I hate owning investment properties, even though I did it. And I thought that's what I had to do because that's what everybody told me to do. And I love owning commercial. So how to figure that out? I gave it a shot. Go try it. Now, learn how to fail in a small way. You don't want to go out and buy an Amazon industrial building for $1 billion and then decide you don't like it and you lost money. Learn how to fail in a small way, but learn how to try different strategies to figure out which one fits. So if you want to buy for cash flow, you really truly want cash flow, go buy in a small house in a small town. That's going to create your cash flow for you. Really quickly, you're going to figure out whether it's for you or not, because you're going to figure out management issues.
Yes.
Is there tenants in there? Maintenance issues? How do you get someone out there to work on it? Whatever it is. And maybe you enjoy having that challenge, and that's okay. You know? Yeah. Either way, you give it a shot. Or if you don't want a small town, go buy a shitty house in a shitty neighborhood. Again, you're going to get your cash flow. Is that really what you want? You know?
Yep.
But just try, again, the point I'm making is just try all these different tactics. At least try one for size.
Yeah, the trying part, what you're doing is you're trying to figure out what your resources are, what you're good at and what you're not good at, both physically and mentally.
Yep.
If you already know that, you can pick.
Right.
And you don't have to try everything.
All right.
Right.
Well, this is where I go back to, we talked about this before too as well, but like a lot of people want any more syndicate deals.
Yep.
And syndications, I want to use all these terms we're talking about. The syndications thrive on the terms we're talking about. IRRs, cap rates, cash on cash. Like that's how they make their money. Yeah. However, understand that being a syndicator, being a really good syndicator, you probably might not need to be that. A lot of good syndicators have already come from some other money world, or have done something as well. So you need to focus on where you can, again, back to earlier, location and value. Where can you add value? Where are you good? And from there, you start figuring out whether you want to play in the cash flow world, appreciation world, cash on cash, cap rate. Again, cap rate means nothing if you're buying houses.
And it changes.
Yeah.
Mine changes. Mine was cash flow. Now, much more of an appreciation buys everything I'll buy in the future.
Mm-hmm. And again, because you've also learned what you're good at and stuff, so you've learned more about how you top line that funnel.
Yeah. Yep.
So
cool. Okay, we'll wrap this up. What do you got going on? We got 4 minutes left. What do you got going on in the next while? What are you looking for? What are you looking forward to? What's going well?
Nothing I can really think of top of that we've got forthcoming as a team. For us internally, we have Mega Camp coming up here in a few weeks, so we'll probably be MIA for a few weeks.
I'm not going.
So, well.
Yep, baby's coming in November, so I'm not.
So I'll tell you all about all the fun stuff we figure out down there. But no, overall, just the market's changing right now. It's definitely been tough out there for the commercial world. Definitely some slow activity. So
yeah, a couple things you mentioned is people are listing properties, but they're just not selling in the commercial world at the cap that they were selling.
Right.
I've noticed that too. The properties come on and they sit there for a little bit.
Mm-hmm. Yep.
Cool. So, okay. Well, our team, we're starting a monthly meetup second Tuesday.
Yes.
My team. Yeah, we're not on the same team. I wouldn't do that. No offense. Second Tuesday of every month, we're going to meet, and I'll have an email out for more details. If you want information on that, email me. Information's below. We'll get it out, and we'll get on the Facebook page and all that good stuff. So, other than that.
Yeah, other than that, not really much. As always, just find us either here, or you can always link to us, or Google either one of our names. We pop up, the Catalyst team as well. And hopefully we add some help or value on this.
Yep, reach out with any questions. We're happy to help.
All right, see you guys.